The capital that used to circulate freely within the crypto ecosystem is being drawn away. Market momentum is siphoning into a massive new void. Macroeconomic attention has shifted. Retail liquidity is no longer a captive audience for crypto. It is flowing into the sudden growth of AI and high-stakes speculation in prediction markets. With that liquidity diverted, the market has lost its ability to move in a vertical, correlated burst. Price action across the board has become significantly more methodical. This friction has split the market into two distinct valuation models. We see a divide between assets held for their story and those held for balance sheets. If you are waiting for a general rally to lift every token in your wallet, you are operating on a timeline that no longer exists. Success in this cycle requires choosing a side of that fracture. On one side are the megacaps. Assets like Bitcoin function as a digital gold, where value is a direct reflection of monetary premium and global adoption, rather than underlying revenue. The other path belongs to revenue-driven utility networks. These are smaller, specialized applications designed as digital infrastructure, capturing fees from the activity they facilitate. These protocols are positioning themselves to absorb a portion of the $600 trillion traditional finance market. They are the bridge allowing stocks, commodities, and private funds to move onto a blockchain. In 2021, a project's worth was calculated through hype and raw user growth, a speculative bubble. The current era is defined by verifiable math, shifting toward bar charts that measure quarterly revenue, price-to-earnings ratios, and on-chain institutional assets. Generating a multi-fold return in this environment requires moving past pure narrative. The growth is now concentrated at the intersection of blockchain efficiency and verifiable financial metrics. Allocating capital to Bitcoin or Ethereum today means participating in a market that has already exceeded $1 trillion in size. At this scale, the primary objective is no longer discovery, but capital preservation. These assets provide the kind of downside protection and institutional security that smaller protocols cannot match. Megacaps are valued on narrative and monetary premium. Their price is a vote on the future of decentralized money, not a calculation of platform fees or quarterly dividends. Because the market is already so large, the expected growth profile is a steady, flat upward curve. Moving $1 trillion needle requires an immense amount of capital. Investors here are trading the possibility of a tenfold gain for a more predictable, methodical growth trajectory that mirrors mature global commodities. Bitcoin and its peers have evolved into macroeconomic safety plays. They remain vital for a balanced portfolio, but they are no longer the vehicles for those looking to significantly outpace the market. Most legacy decentralized finance apps were built with a structural flaw. They facilitated billions in volume, but lacked a mechanism to return that value to token holders. Capturing revenue was seen as a legal liability. Developers feared distributing fees would lead to immediate enforcement actions and the label of an unregistered security. This left early investors holding tokens that were governance only. They had no claim on the protocol's success and no fundamental floor to support their price during a downturn. The model has changed. Modern platforms are actively turning on value capture, using protocols to buy back and burn their own tokens, using the revenue generated by active traders. Value capture altcoins function like fintech stocks. We can value these assets using price-to-earnings ratios and hard revenue data. However, this shift toward cash flow increases regulatory threat. By acting like a security, these protocols invite closer scrutiny from legislative bodies. Utility tokens now offer actual fundamental value, but they demand a specific trade-off. The investor must be willing to hold through the high risk of sudden regulatory interventions. The race is on to tokenize real-world assets like oil, silver, and private equities. Two different types of organizations are fighting for this space. Traditional brokerages like Robinhood are moving onto the blockchain by launching their own Layer 2 networks. They're bringing the old world into the new. Their advantage is a massive built-in user base. They have the institutional trust required to onboard millions of retail customers who are still wary of decentralized finance. But these incumbents move slowly. Their development is weighed down by corporate bureaucracy and a deep-seated fear of making a regulatory misstep. Simultaneously, crypto-native exchanges are integrating real-world assets into their existing tech stacks. They are building the new world to replace the old. These platforms are the speedboats of finance. Their agility allows them to deploy new markets and capture market share in months, while the larger incumbents are still debating their first move. The risk for these nimble players is scale. If a trillion-dollar traditional firm commits its full balance sheet to the space, a crypto-native startup can be overwhelmed by sheer financial force. Both groups are converging on a single point. The winners will be the platforms that successfully blend the agility of a startup with the regulatory maturity of a bank. The immediate health of these revenue-generating tokens depends on the Clarity Act. This piece of legislation will determine whether these platforms can operate with the blessing of the law or in a shadow of uncertainty. Failure to pass this bill will trigger a period of intense volatility for any token tied to a cash flow model. The fear is that a hostile political shift could lead to a rollback of recent progress, creating an environment where the industry is actively discouraged from innovating. Yet, crypto may have already reached the Uber threshold. It has gained enough momentum from global asset managers and retail users that it has become too integrated into the financial system to be dismantled. While Wall Street adoption ensures the industry's long-term survival, your personal portfolio's short-term health depends on how much regulatory delay you can afford to witness. Your next move is determined by your primary investment goal. If you prioritize capital preservation and want to avoid the stress of regulatory shifts, stay with the megacaps. Focus your allocation on Bitcoin and the assets that have already achieved institutional status. By choosing this path, you are accepting that a trillion-dollar asset cannot double with the same frequency as a small protocol. You are trading market-leading gains for methodical appreciation. If you are looking for the potential to significantly outpace the market, you have to move away from pure narratives. Your focus must shift to the revenue capture side of decentralized finance. Target the specific platforms sitting at the intersection of crypto and traditional finance. These are the protocols that prove their value by passing real revenue back to their holders. Success in this new market isn't about finding a token that is stealing users from a rival. It is about identifying the platforms that are expanding the entire market by moving the world's $600 trillion of assets onto the chain.